Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about SoFi. So, SoFi has been really hit lately, like all growth names, just that has been meaningfully sold off. So, I'm going to go through some of the kind of the bearish considerations that you might think about, and particularly putting a focus on what the bank charter implication will have towards SoFi's stock. Okay, so as you can see here, it's been a really tough period for investors in the past 12 months. It's been really, really volatile, up and down 20, 30% at a time. And right now, as it stands, everyone looking at SoFi is like, if you've been invested in the stock, you're holding a loss. And that has meaningful impact on how you view the business as a whole. So you are thinking about the business and you just focus on the share price. And everyone's just focused on the share price is really frustrated right now, and I'm just saying, take a step back and try to think about the business, and that will give you some conviction to really try and stay the course. Now, one of the things that is quite important here is just the consistent amount of selling off that has been in the last several days. And that's what I really wanted to highlight here. And note that as we go into Q4, we're seeing an acceleration on its revenue growth rate. So this is important for two things. First, if you think about it, right, for the past 4 quarters, there's been a consistent rapid deceleration of its revenue growth rate starting from Q4 of last year, where the revenues were up 168% year over year. So there's steady, consistent decline in revenue growth rates. Now for Q4 21, they're pointing at the guidance to be up at the high end of 55%. So that's important because there's an acceleration. Secondly, it's important because Q4 of last year was actually the strongest revenue growth period. So for them to be able to lap that period and still come out with very compelling guidance is really, really attractive. Now, this is the gap revenue guidance, is not the adjusted that sometimes people focus on. So I've just focused on the gap here. Now, the business has three different segments. So there's the lending segment, there's the tech position, and there's the fintech position. So the fintech is where most of the bullish case is really contingent on. There's going to be an explosion here, and the business is going to go from just lending today to be three-part, kind of much more diversified business, which will add to the resilience of the business as overall, which should impact the multiple that people are willing to pay for the stock. Now, if SoFi gets the bank charter approval, there is kind of two things here that you need to kind of think about, right? So it's kind of a double-edged sword, and that's what I want to kind of analyze here. So let's say that SoFi as a whole continues to progress as it is without the bank charter, so the base case as they call it. So that implies that there's going to be from 2021, where EBITDA margins are approximately 3%, there's going to be a substantial increase over into 2022, where the EBITDA margins are going to be approximately 17%. Okay, so that's leading to approximately a 10 times increase on the EBITDA to go from 27 million to 200 and let's say 255 million. So it's just a huge jump. So that's really interesting. That's really compelling. That's something that's very, very interesting. Now, let's say that they do get the bank charter approval. Okay. Now, this would impact that the EBITDA line would absolutely explode. It go from, let's say, finishing 2021 with 40 million of EBITDA to nearly 450 million of EBITDA. So it's going to be like just a huge jump right here, and that will put the stock trading at 23 times the EBITDA for this year. Very, very strong, right? Now, on the other side of the equation, if you think about it, right? So if we just look at the balance sheet, SoFi's balance sheet already holds approximately 2.7, 2.8 billion of debt. Okay, even if you take out the cash position of 500 million, you still have about a bit more than 2 billion worth of net debt. Now, for a business that's valued at approximately, let's say, 10 billion, for it to have 2 billion of debt is, it's quite leveraged as it is. But if you do end up getting the bank charter approved, yes, you do see a strong amount of growth on the EBITDA line, but due to the Federal Reserve's regulation of the bank, it will mean that the balance sheet will be meaningfully restricted. Okay, so one side of the equation, yeah, if they get the charter approval, the stock trades 24 times EBITDA, very, very interesting, cheaply valued, particularly that so many fintechs are priced at 24 times sales. So that's really, really cool, right? The other thing is that if the fintech community starts to view this less as a fintech stock, but more as a traditional bank, the multiple that people will be willing to pay would compress because the balance sheet will be more restricted, it will be less nimble, there's less things that it could do, they will be less opportunistic. So 24 times EBITDA would probably compress the multiple and the stock could also sell off. Now, everything that I've kind of highlighted here already, this has been known for several months. And the only difference right now is that the stock trades at a 40% discount. So if you were quite interested in the stock beforehand, before the 40% discount, this is a chance for you to kind of slowly average into your position. You don't have to kind of, go all in right now because you never know how the next, 3, 6 months go. But also what I'll say is that everything that I've just discussed has been known for several months, and before people weren't that concerned about them, even though they knew about him. But right now, everyone knows about it, but the level of concern is really, really high. And it's often quite interesting to notice that divergence. So when people are really, really worried, a lot of it is already factored into the share price. And that's actually often a really good time to kind of average into your investments to kind of buy them at a discount because you should really think about your investment as being the owner of a business rather than the owner of the shares. And that really adds to your conviction and your ability to hold on to the stock. So in any case, if you want to find out what stocks I'm going to invest right now, particularly during the sell-off, don't forget to check out my marketplace called Deep Value Returns. See what other people have said in the reviews. That's always a good place for you to start and come in and drop me a line. Okay, thank you so much for listening. Bye.